Hi, hello friends. Good evening, everyone. Welcome everyone to Nifty Banker 2.0, India's first retail index traders online conference. I am Ashok Devanampriya, the CEO of Traders Gurukul and also the host for your today's program. It's a great pleasure to invite every one of you into this program today. Before we kick off the show, I would like to thank our media partner, Money Control Pro, the largest financial portal in India with millions of daily readership on their website, and our title sponsor, Espresso, the leading discount broker in India from the family of Sher Khan. The speaker for today is Mr. Jay Thakkar from Mumbai. He is the Vice President and Head of Research in Marwadi Shares and Finance Limited. A passionate technician with main focus on fundamentals, technical, quantitative, and derivatives. He's a CMT and also a Elliott wave specialist. He uses technical and derivative analysis for trading, where he tries to blend both technical and fundamentals for investment. He has been in the industry for little more than 11 years right now. Okay. Broadcasting has not done. That is the root cause. Dude, I'm taking a stop here. Hi, hello friends. Welcome everyone to Nifty Banker 2.0, India's first retail index traders online conference. I am Ashok Devanampriya, the CEO of Traders Gurukul and also the host for today's program. It's a great pleasure to invite every one of you into Nifty Banker today. I am sure by the end of this program, you will have a lot of knowledge which can help you to make better trading decisions in your trading life. I would like to thank our media partner, Money Control Pro, the largest financial portal in India with millions of daily readership on their website, and also our title sponsor, Espresso, one of the leading discount brokers in India from the family of Sher Khan. The speaker for today is Mr. Jay Thakkar from Mumbai, who is the President and Head of Research at Marwadi Shares and Finance Limited. He is passionate about all types of research, including fundamentals, technicals, quantitatives, and derivatives. He is a CMT and also an Elliott wave specialist. He has spent close to 11 years in the industry so far. My dear friend, Jay, it's a great pleasure to have you on board as a speaker. So friends, he is going to educate us on his special topic, creating successful options payoff using charts. Dear Jay, on behalf of Traders Gurukul, Money Control Pro, Espresso, I extend my warm welcome to you into this program as a speaker. Go ahead, my friend. The stage is yours.
Thank you so much, Ashok, for such a warm welcome introduction, and it's been really, wonderful, being a speaker or presenter in Nifty Banker. I know it's quite a thing that people, traders in the market look out for or watch out for. So thanks, Ashok and team, for having me. And yes, it's been like currently I'm working with Marwadi Shares and Finance Limited, as you rightly said, and in the past I have worked with the parent organization of Espresso as well, that is Sher Khan Limited. I have spent almost 6 years there, and
Wow.
the first speaker of the Nifty Banker 2.0 session, Mr. Rohit Srivastav, I and he have worked together for almost 6 years. So yeah, it's quite I would say kind of recollecting all those memories back, and good to start today's session, which I have thought of, that is creating options payoff using charts. So here we go.
Great. Thank you so much, my friend. I think this clearly proves that the world is very small.
Absolutely. So Ashok, is my screen visible?
Yes, please move on to the next slide.
Sure.
Yeah.
So here it is. I mean, it's like as it's again mentioned that it's option strategies or option payoffs using charts. So how are we going to do this now? So I'm sure that many of you friends must have guessed well that what all we are going to do tonight is that which option strategies, which option, how would you create these option payoffs for profitable option payoffs using charts. And in that, using charts is like using technical analysis. I mean, what all technical tools are you going to use, and which are very simple, I would say, friends. I'm going to explain you much in detail today, which are very much in useful, that will help you to basically make a decision which strike to choose. Because see, first of all, whenever you are trading options, there are two things in options, friends. One is option strategies, and second is plain vanilla options, right? You have to think that which strike to choose when you are doing an plain vanilla option, as well as you have to think that which option strategy should I deploy at the current moment. And while deploying that option strategy, there is also one more dilemma through which traders go through, and that is which strike to choose, right? So that is one thing which I'm going to help you out to decide that which strategy to be deployed when using charts, and which strike to choose with the help of technical analysis. So I move ahead now.
Yes, please.
Yeah.
So,
okay. Yeah, you want me to stop here?
No worries, you can go ahead. So the sponsor for today's session is Espresso, the Sharekhan company. Thank you very much.
Okay. So here's a little bit information of myself, that I'm heading the research, and I'm vice president at Marwari Shares and Finance Limited, as Ashok also mentioned. Now we start with the candlestick patterns first. So friends, in today's session, the blend of technical analysis is what tools in technical analysis I'm going to use. Very basic tools, I'm sure, and most of the popular tools as well. So as far as the charting techniques are concerned, or chart types are concerned, rather, I would say that three chart types are very, very useful, or I would say frequently used as far as India is concerned. I mean, when you go to the Western world, many of them use point and figure as well, which is not that popular out here in India. But then three important chart types which are famous are bar chart pattern, candle chart pattern, and line chart pattern. Okay, of which I have excuse me, selected or included candlestick patterns as a part of this topic. The reason is that, friends, candlestick patterns are one which helps you to understand the reversal well in advance compared to any other chart types, or maybe it is one of the best reversal methods, as far as which you come to know using the chart type. So if you are using a bar chart pattern, so there are very few bar chart patterns actually. I would say plainly on the bar pattern, or plainly on the construction of a bar chart, there are very few patterns. On the line chart, there are no such patterns. I'm not talking about the patterns such as triangles or head and shoulders, or maybe the flags or the parallel channels and all, because not that, because that take a lot of time to get formed, right? It's entire consolidation. When that entire consolidation is formed, thereafter you make the decision, right? So that's not that frequent, right? Whereas candlesticks, they're on their own themselves. They create reversals. Maybe you have a one candlestick reversal patterns, you have two candlestick reversal patterns, you have three candlestick reversal patterns, right? So at least if you have using these three candlestick reversal patterns in 1, 2, or max 3 candles, you have the reversal in hand. And once you have that reversal in hand, you know the trend, right? So friends, whenever you are doing a derivative strategy, what is most important thing? Most important thing is that you have to know the trend. Okay, and or else you have to know that whether it is going to be trending right now, or it is not going to be trending right now. Now we are not using any of the option Greeks in today's session. So I mean, it's just my first session with the Traders Gurukul and others. So I'm not using Greeks and all. We are just using charts today, or So using charts is what we are going to create the option payoffs, and not using the other derivative tools. Okay, purely on charts. So basically, candlestick charts help you out to understand the reversal quite at an advance. So many of us know that Dow theory is the basic of technical analysis, but then Dow theory reversals we come to know only when the previous lows are getting broken. So I'm going to use charts now along with what I'm actually talking. Okay, so let me just take a chart out here. Yeah. Okay. So here now, see friends, if you check like this, so I just convert this into a line chart now. So here on a line chart, what happens is you come to know about a reversal when the previous low is broken on a Dow theory. So Dow theory is nothing but you have a series of higher tops and higher bottom formations. So yeah, this is what happens in a Dow theory. You have this uptrend, you have the downtrend, then uptrend, and then downtrend. Again, you've got an uptrend, and you have this chain of an up and down trends, right? So you keep on riding the trend until unless there is a reversal. When the reversal will come, when for an example out here in this case, when the previous low gets broken, here is when if you want to automate this thing, you can automate this thing as well. We have in our organization automated Dow theory as well, so we get the reversal signals using Dow theory fully automated. So those who are very well versed with the coding as well, so they will come they will be easily able to code Dow theory. We have done so successfully. So now here is where you get the reversal on a Dow theory. So you have missed this much, you have missed this much. That is fine. I mean, so that's there are different ways of doing it. I'm just going to show it out to you today that without missing this, what if you get the information right here? So if you are using a candle chart pattern, for example, let me just convert into a candle chart pattern now. I'll let you know. See, this is how a candle chart pattern looks like. So there are so many candlestick form. Okay, for example, just for an instance, that this is a candle that's been formed out here. Right now, here itself, if you get a reversal, I mean, assume that this candle is formed here. So if you get an information here itself, rather than in this particular case, if you get a reversal when the previous low is getting broken out here, here is when, according to the Dow theory, you get a reversal, higher tops and higher bottom. If you want to check, then I can just convert this into a line chart again, so you can see somewhere here, maybe here, if you're considering this as the swings. So here and here, or here or here, just imagine that using candlesticks, you are getting a reversal quite in an advance, right? So that was the main purpose of selecting candlestick chart type, or for understanding, because the options basically what, whenever we are trading options, one thing one has to keep in mind is that on the day of on expiry, most of the options get or expire worthless. That is one thing, and you have a very limited time. You just have 20 trading sessions approximately, right? And of that also, now if you remove the last 3 to 4 trading sessions because of these heavy rules and regulations, wherein you cannot hold the options much in the money, you have to square it off and all. So basically, that is what the action happened in the last trading week. So ultimately, if you see that if you want to play the current expiry, for example, if you want to play the February expiry, then you'll be having out of the 4 of trading weeks, or you're going to have 3 trading weeks. And in case any particular month when you are going to have 5 trading weeks, then assume that you are going to have fully 4 trading weeks only, right? So that's how it is going to be. So you have to time it very well, and for timing you require the exact reversal, or an early reversal rather than a late reversal. What if you get a reversal here on a candlestick chart, or on a line chart or a bar chart, you get a reversal here, and that is after a 15th day or 20th day. Now you have only 2 or 3 days to act. So you will not be able to act now here, and now you have to act on the next expiry. And when you are acting on the next expiry, maybe 2 or 3 days before, you don't have much of liquidity on the stock side. Okay, if you're doing it on the index side, it's fine. On the stock side, you won't be having that much of liquidity. So thereafter, the entire move, you have captured the move, or you understood the move, but then you couldn't act. So that is the reason I have used candle chart pattern now. So that was a logic to use candle chart type. Right now we have to understand that what is this candle chart pattern, how are they created. So many of you who are attending today might be knowing that what is a candle chart pattern, but then many, I don't know, must not be knowing also, I don't know. So we just go through the basics of construction of candlestick lines. Okay, so this is how it looks like. This is a candle chart pattern. This is a clear bar chart pattern. So you can see in a bar chart pattern you don't have that body, and in a candle chart pattern you have this rectangular box in the middle. So this rectangular box is called a real body. The upper end and the lower end are called shadows. Okay, the upper end is called the upper shadow and lower end is called the lower shadow. There are I would say this real body basically helps you to know the sentiment of that particular day, and that is what helps to the for the reversal as well. So if it is closed in green, that means bulls had an upper hand, and if it is closed in red, then bears had an upper hand. Now there are different types of candlestick patterns. I mean different ways of analyzing candlestick charts. So we have seen that it is green and red in color, right, friends? But then sometimes you have filled green and sometimes you have hollow green. So here you can see that this is a filled green candle. I don't know whether you're able to see it properly. Yeah. So this is a green candle, green filled green candle. Okay, and these are hollow green candles. And so in an upside, either you have filled green or red, hollow filled green or hollow green. And in a downside, you have either filled red, which is in most of the cases, or you have hollow red. So either you have filled or hollow. How to decide that whether it is a filled or hollow? Is it going to make much difference? Not much difference, but yes, definitely it will help you out to understand the sentiment, and it will also help you out to understand which strike to basically choose. So yeah, we go to the next part. So this is a real body. The upper and the lower parts are called the shadows. Now construct understanding the filled and hollow parts. So generally, friends, what happens is when the real body is black or red in color, it means close is below the open. Okay, and also the close is below the previous close. So whenever it is a filled red, okay, whenever you have a filled red candle, that means today's close is less than open, as well as today's close is less than the previous close. And if it is not filled red, if it is hollow red, means today's close is lower than the previous close. So whenever today's close is going to be lower than the previous close, it is going to be red in color. Hollow or filled. It is hollow if it is higher than today's open. So if you can see, the opening price out here is 35.90 and the closing price is 36.20. Whereas out here you see it is filled red. So filled red means closing is lower than opening, right? So the closing is lower than both opening and previous close. It is filled red, and when the closing is lower than the previous close, but it is higher than today's open, that means it is a filled red, hollow red. Likewise, for a green candle as well, what you have is for a green candle as well, you have whenever closing price is higher than the previous close, that means it is green in color. Okay, today's close greater than previous close, green in color. But then today's close is greater than today's open as well, then hollow. And if today's close is lower than today's open, then it is filled. So it's very simple, I mean, to understand this. And if you go and check or maybe go and study much more in detail, you will come to know that as well. The thin lines above and below are called shadows. If the candle line has no upper shadow, it is said to be a shaven head. Sometimes what happens is, friends, there are a few candlestick patterns wherein you don't have the shadow on the upside at all. So it looks like something like this. All right, and it looks something like this, wherein you don't have a shadow at all on the upside. This is called a shaven head. So, and vice versa, when I invert the chart, and suppose if you don't have a lower shadow, then it is called a shaven bottom. So here if you go, this is one candle pattern, candlestick chart. Here you see there is no lower shadow. This is called shaven bottom, right? It's called a shaven bottom. And if you want to check the shaven head, then there are this here, or this is one which is a shaven head almost, or maybe this is the one which is a shaven head, so very less or no shadows is called a shaven head. A candle line with no lower shadow is shaven bottom. So this is what we have already cleared. Now these are few candlestick things which I am going to show it to you, because these are going to be very important. So of which, friends, we have understood the basic construction of the candle. We know what is the real body, we know what are shadows. Upper part of the range and lower part of the range above the bodies are called shadows. And We have seen what is a shaven head. We also know what is a shaven bottom. So interestingly, friends, what we also want to see is that what if a candle is having no real body? See, like this. Here shown in the PPT, there is no real body. See, no real body. This type of a candle is called a doji candlestick pattern. Doji, right? Wherein the opening is almost same as the closing, right? And there are few candlestick patterns, if at all there is a very small real body out here. Okay, are this important to know this? Yes, it is important. Why? Because going forward, when we study candlestick patterns in detail, you will come to know. So this is called a doji star, wherein the opening and closing are very close to each other. And sometimes what happens is basically you have a little bit more real body, but then the overall the real body is quite smaller compared to the normal candles. So this is called a spinning top candlestick pattern. So if you see my PPT out here, it is already written that this is a doji wherein there is no real body. A little real body than this is called a doji star, and somewhat more real body than that is called a spinning top candlestick pattern, right? Then like we have gaps in candlestick, we call that as a window. Okay, so when this is a day one, this is a day two. When day two opens gap down, and there is a gap between the lower shadow and the upper shadow of the day one and day two, it is called a falling window or a lower gap. And whenever after a day one, day two, whenever day two is a gap up, and there is a gap, clear gap between the excuse me, shadows of the upper shadow of day one and lower shadow of day two, it is called a rising window or upper gap. So these are called gaps, and these gaps will also help us to determine the strike prices. I'll let you know how to use these gaps as the strike price and everything to understand which strike price, because they will act as a support and resistance, technically. So this is about the basic of candlestick patterns, friends. Just give me a minute. I'll just sip of water. Yeah. So this is all about basic of candlestick pattern that we have covered. Now, second thing which we are going to use today, apart from candlestick pattern, is Fibonacci retracement or extension levels. So Fibonacci is what we are going to use. Why we are going to use Fibonacci? Because Fibonacci retracement or extension levels are going to help us. To know the targets and the stop losses